Hey everyone, welcome back to Corporate Decoder, the place where we sift through all the business filings so you don't have to. Today, we're diving into Earth Science Tech, and let me tell you, their report is a bit like that smoothie you made with every fruit and vegetable in the fridge. You're not quite sure what's going on, but you hope it's good for you. What did we discover in this report? Revenue is up, but so are expenses. They're making some acquisitions, and their leadership has a new compensation plan. Let's break it all down. First things first, this is an amended report. It's like they realized they made a mistake and are trying to correct it. They messed up the number of common shares outstanding, which is a pretty big deal. They also had to fix the gross profit amount. It's important to note that they are saying that this amended report speaks as of the original report date. Now, let's jump into the financials. Looking at the balance sheet as of December 31st, 2024, Earth Science Tech had about $522,000 in cash. That's down from about $698,000 back in March. It's like they spent a bit more than they earned over the last few months. They have accounts receivable, which is money owed to them, of about $164,000. One interesting thing is they've added a line for equity investments worth about $1.1 million. This is new and it means they're putting money into other companies or investments. Their inventory, which is what they have on hand to sell, is around $138,000. Total current assets, things they can quickly turn into cash, are about $2 million. On the other side, they owe about $46,000 in accounts payable. That's the bills that they have to pay, and about $1.4 million in accrued expenses, which are costs that they know they have but haven't paid out. They also have about $755,000 in the current portion of loans, which means it's the amount that needs to be repaid within the next 12 months. Total current liabilities, all those short-term bills, come out to about $2.3 million. Overall, the company has about $5.7 million in assets and about $2.4 million in liabilities. Moving on to the income statement. For the 3 months ended December 31st, 2024, Earth Science Tech brought in about $7.4 million in revenue. That's up from about $3.8 million in the same period last year. It's good to see them growing sales. However, cost of goods sold, the direct cost of making their products, also went up, which is normal when sales increase. The company made a gross profit of $5.1 million compared to a $2.4 million last year. Here is the interesting part. Operating expenses skyrocketed from about $2.1 million to $4.9 million. Salaries went up a lot, 300%, and they started to incur bank charges, credit card fees. After accounting for other income and expenses, the net income turns out to be $206,000 compared to $225,000, which means their profit actually decreased by 9%. Their profit per share is less than a penny. Looking at cash flow, the company generated $2.4 million in cash from its operations over the last 9 months, which shows it is a viable and profitable business at its core. Backtracking to the business operations, Earth Science Tech operates in a few different areas. GaiaXCompoundStore.com is their compounding pharmacy, making customized medications. They are working on getting licensed in more states. Mr. Meds is another pharmacy located in Texas that they plan to get up and running soon. Peaks Curative, another arm of the business, is a telemedicine platform connecting patients with doctors for prescriptions. Avinvi, a real estate company, manages investments and oversees their share repurchase program. It's important to note that the company is also repurchasing shares in the open market. There are also other non-cash transactions such as loans and share payments to consider. The company took a non-cash hit to revenue that is part of normal businesses. The company has 3 very large customers, which make up over 10% of the total sales, and they are core to the long-term business success. Earth Science Tech also relies on a few raw material suppliers for most of their products. So if something happened to those relationships, it could affect their ability to get materials and sell products. The company has goodwill, an intangible asset resulting from its previous acquisitions. They review it yearly, so you need to pay attention to it. Earth Science Tech has some debt through equipment financing and short-term loans, and it's important to know how they're managing these obligations. Now, the company has a couple of related party transactions to note. They pay the salaries for two key leaders to their consulting companies and acquired companies with related ties. This means those people may be owners or have influence over both companies. Finally, there is a major change in CEO and COO compensation plan coming as of January 1st, 2025. Their base salaries and bonus amounts will be significantly higher if the company can increase in assets by 5% from quarter to quarter. The CEO will earn 10% of the company revenue each quarter, which is a huge amount. Looking ahead, Earth Science Tech is planning to buy even more companies. They plan to purchase another company called Las Villas Healthcare for a total of $400,000. They will also purchase Magna Fuse for $240,500 in addition to other agreements. These are recent developments that may change the company's direction. Now, let's zoom out and see the big picture. Earth Science Tech is definitely growing, but not without growing pains. While revenue is up, expenses are also way up, and the new CEO/COO compensation structure is very aggressive. The biggest risks seem to be Asterisk relying on a few key customers and raw material suppliers could hurt their business if something goes wrong. Asterisk, these new high-growth companies might not actually succeed, and those acquisitions could end up not paying off. Asterisk, the heavy related parties' involvement requires transparency. On the flip side, the business is growing fast and becoming more profitable with increasing revenue. If they manage to control costs and successfully integrate these new acquisitions, the company could expand significantly. From a valuation standpoint, it's tricky. They're making a profit now, but with the high executive compensation being a huge percentage of revenue, it is hard to pinpoint. Given these factors, a fair target price range would be between 7 cents and 10 cents. This depends heavily on their ability to manage expenses and make these new acquisitions profitable. Overall, my recommendation is neutral, with a bearish bias. The increased revenue is encouraging, but this new compensation structure is cause for concern. It's a bit too risky right now, but check back in the future. If you found this helpful, don't forget to subscribe for more corporate decoding.